All right. We're good? Okay, I just want to make sure everything's going to pop up like it's supposed to pop up before we get going. Hey, everybody, Jason Elkins, Carolina Capital Home Buyers. Hey, I'll buy houses if you hadn't noticed, but I also help people become the bank. But tonight we're going to talk about what the investor's secret weapon is. And you know what that is? What is private lending done the right way? Because you can't do anything without what? Money. You got to have money. And this, what I'm going to share with you, is for both active and passive investors. There are people who just want to be the money guy, and there are others that want to be active, and we'll talk about that more. But of course, a little disclaimer: everything we're talking about is educational. If you walk in the door, you've got lots of people to share experience with you. Like Isaiah, I'm excited every time I see a young man, right, in the tables. I get really excited about that because I just think if I was that young man sitting there, how much further along and how much different my life would be sitting in a room like this right here today. So, but anyway, this is all about education today, and that's why we always have to have a little disclaimer on that one. About me, I live by protect, lead, and build. That's what I live by. So, because I've been in security, and I'm still in security for over 28 years. It's who I am. It's what I know. It's what I do. And that's how I think when I think about risk mitigation mindset. I've been in martial arts since I was 18. I've taught hundreds and hundreds of students, owned a school for about 20 years. So I've had that before too. So I kind of take that mindset, that discipline that goes into what I do with real estate investing, and now also with private money lending. Real estate, like we talked about, I started off with some rentals in 2002. Hey, we had a couple kids at the time. We had a townhouse. It was 2 bedrooms, 1.5 baths. We were growing. So we said, hey, let's take that one and make it a rental. And then that's the way the journey kind of started with it. Just something simple, and that's the way it starts. 2020 had a big old reset. And who had a reset in 2020? I did. I sure did. Divorce, COVID, got rid of all my rentals. The most money I made with rentals, and I'm not going to bash rentals because everybody does a great thing with rentals. You all have your thing. Some people are really good at flipping. Some people are really good with rentals. It's just whatever your niche is. Some people like storage, and that's what they do. There's nothing wrong with any of that. But for me, I was like, I've got to find a better way. So I spent a couple years just feeling my way around real estate and doing a lot of study before I got into what I'm talking about today. From hustle to control. So, flippers in my room. Is there a little chaos that you have to chase sometime? Yeah, a little bit. So, that's okay. There's nothing wrong with that. But I'm here to tell you that chaos, what you need is control. All right? You need control. You need control of your time. You need control of your capital so you can have control of all of your outcomes. And that's where you come in for a private lending. Because lending, if you do it the right way, it's going to build you that framework. It's going to build you that structure that you need to be able to move forward. All right, what is private lending? You can Google that, what private lending is. So private lending, this is the key to it. It's a flexible partnership. I'm going to stress the word partnership. It's where capital is secured by real property, not a stock, not a Bitcoin. Who lost money in Bitcoins? Something that's tangible asset. It can fund something quick. Maybe you've got a short-term project, you've got a quick flip, you've got a house, needs to go. Or it can create a predictable long-term income, which includes fully amortized notes, that are paying monthly principal and interest up to 60 months. If you have a couple paths here for it, short-term, that tends to be, it could be 6 to 12 months, right? Interest only, maybe you have a balloon at the end. Quick turnaround so you can recycle your capital. Whereas long-term, we're looking more 3 to 5 years, right? That fully amortized, right? Getting that monthly predictable cash flow with that real collateral. And both of these instances, you become the bank on all of this. All right, let's take a look at private lending versus hard money, and this is just some general. You can slow me down if I'm going too fast, right? Ask questions. So private lending, we talked about that a little bit. It tends to be more relationship based. I've heard that in here tonight about people lending each other money, right, for different projects that are going, and that capital is being circulated, right? That's private lending. Whereas, hard money, it not always, but it tends to be institutional, right? When we need hard money, so don't think about, hey, hard money's bad. We need all the money, right? All the kinds of money for all the kinds of things. Private lending tends to be flexible, right? More flexible on it. Hard money, it's going to be more rule driven, right? A little tighter on the rules on it. Private lending, you probably get somewhere between 8 and 14%, depending on what you're doing with your relationship. Hard money, and I'm sure you've seen some numbers outside of this. It's going to be between 12 and 18%, and you're going to pay points on top of that money, right? Private lending, partnership mindset, that's the shift here. I'm really big on private lending. Transactional mindset's really more of the hard money side. It's that bank, right? Private lending can be short or long term. Those quick projects, those longer term. Maybe you have a buy and hold that you want, and you need a partner with that one. Whereas hard money, they're recycling capital. They got to get in, get out, next deal, right? It's usually pretty short term. And I'll have a question and answer time at the end, of course. I'm not sure why we blurred. That's interesting. Well, the structured safety. So there's 4 documents up there that are blurred for some reason right now on the screen. So when we talk about private lending, we talk about an asset, something tangible that we can tie our money into. So first legal document is going to be our mortgage, right? The mortgage is going to have everything we need, the terms and whatnot. Promissory note is also going to be in there. It tells us about the length and the percentage rates. So these are 2 legal documents that you're going to make sure that you have with every single private lending deal. Title insurance and closing protection letter with that. So making sure that title is going to be unencumbered. And that's important because we don't want to have to go fight a battle 5 years down the road because there's some title infringement somewhere, right? We don't want that to happen. And of course, property insurance. Property insurance, collateral, we got to protect it. That is, if you're lending money, when you're lending money on something, you want to make sure that asset's protected. Now, for me, when I have a private money lender that's helping us out, then I say, okay, I'm going to take care of the insurance. I don't want to put that burden on my lender because they are providing the opportunity for me to expand, for me to do a deal, for me to go to the next thing. And all these documents right here are going to turn any risk that you may have into structure, and that structure is going to give you more confidence in the deal as long as you've ran your numbers. All right, let's look at the lending spectrum here, okay? On one side of it, we talk about hard money. It tends to be higher rates, right? Stricter terms, and they're looking at a quick exit on that. On the other side of that, we got the traditional bank. Are banks traditionally slow? Yes. Do they have a lot of red tape? Is there a lot of bureaucracy and regulation tied up in banks? You better believe it. So it's kind of difficult. I mean, who's had a mortgage on a personal property lately? How many times did you sign your name on the, that's what I need right there. Just just a stamp that'll do it. How many times? Whereas private lending, it's going to be more flexible, right? It's secured, and it's going to be a relationship. Again, I'll go back to the conversations that I've already heard in the room today about, hey, I've got this, I've got that, and how we're exchanging the money. So it bridges the gap for some of this. And all of these are part of your real estate success. All of these combined. But private lending is going to be your most flexible. And it's going to give you the consistent returns off of it. Okay, let's look at, I guess our internet is giving up. Let's look at, this is why we have backups for everything. Here we go. When the internet gives out, you have a PDF. Let's look at short-term lending. Make sure I get the right one. Right slide. Short-term lending. This is the typical flow of it. First, there's the funding. You're funding a loan, right? You're going to have that. Could be a rehab project that's coming in for a short-term lending. You're going to sell it. Maybe you're going to do the BRRRR method on it. Refinance it. Maybe you're going to buy and hold. Could be, but that's not typically short-term. So for our example up here, maybe you've got a $100,000 loan at about 12% plus points. That's going to be around $7,000 total return off of that money. Not bad. 6 months, but do you have to be in that capital all the time, making sure certain milestones are being met? Yes. Yes. And in 6 months or so, whatever you negotiated, it's recycle that capital and it's ready for the next deal. But this is an active investor. Short-term lending is an active investor portfolio. It's velocity, it's quick returns. It's like, I like to think of it as just like cash flow cardio, because you got to be in it, you got to be involved, you got to check the boxes, especially when you start getting draws. Long term. Well, you may have a $30,000 principal, and you're going to ask me, where do you get a $30,000 house? They're all over the place. You just got to know where to look, like anything else. Still going to be collateral backed. For a $30,000 loan, you get back your $667 a month. Really, it's for this 12% example, it's $667.33. Somebody told me to be more specific on that last night. So that 33 cents matters when it's coming in every single month. And over that, that time period there, that 60 months, your 30 turned into 40. It's actually $40,040 to be exactly precise on that, with a 33% ROI on it. Not bad for a passive investment, right? You need to check your bank. You need to make sure your monthly payments are coming in. But you can do that on what? Your phone, right? To make sure it's coming in. This is as part of either your short-term or long-term, your mix. This can give you that stability, that line that you want. Because when you're flipping houses, is your income like this? Right? Like this? Yeah. How about, what would happen if we had this going on? Yeah. We want. This is okay as long as you've got this on top of it, right? So that example again we talked about was $30,000 loan, 12% amortized, kind of like a car. Who's bought a car lately? Who's had a car loan lately? Yeah. Said 30,000. So do you pay that? Do you pay just interest along the way and then you pay it all off at the end? You pay that principal and interest the entire way you're going, so that by the end of it, loan satisfied. And that's for you as the lender, you're getting consistent monthly income. That flat line we talked about. The good flat line, not the bad flat line where you end up in a place you don't want to be. All right, let's look at lending structures. Each one, so short-term lending duration, we talked about 6 to 12 months. Long-term lending, 3 to 5 years. You can go longer than that. That just depends on the relationship you have. For me, a lot of times people just, once they see their money growing, they don't want it back. They want to put it in a self-directed IRA somewhere and just let it keep on keeping on, right? Let it build. payment type for short-term lending is typically going to be interest only with the balloon here at the end, big balloon. Balloons pop though. That's important to know about that. What would be well, we'll get back to that. The long term is fully amortized. Quick payout on your return pattern, on your short term, and your steady income for your long term. Who likes steady income? I like steady income too. It's great. Risk. Short-term lending. We talked about flips. Are there any risks with the market? All right. When you get into a deal and you've got one number, is it always that number at the end? No. Sometimes, JD can stop me on this, sometimes that number is higher. And that's a great day. That's a great day. Sometimes that number's down. Sometimes that number's down here. And that's not a good day at all. So we have, anybody had a project delay before? Never. Anybody pulled down the sheetrock and said, oh boy. Yeah, now you need a permit, by the way. Yeah, there you go. There you go, Jordan, to get a permit. So there's risk that is kind of associated with that short-term lending, especially if you are the person lending. Maybe if you didn't do your due diligence on that property, because I'll say that, you need to do your due diligence on both the person and the property. Don't just take their word for it, because you're on the hook, okay? Risk more in the long-term lending is, well, it's the borrower's performance. You know, what's their track record like? Short-term lending, that's ideal for those active investors. We talked about that cash flow cardio, because you got to be in it. You got to meet those benchmarks. You got to make sure that whoever you are loaning the money to is, hey, I want this draw. Well, what have you done? Hey, I want this draw. What have you done? Whereas the long term is more passive. I got to check my phone app and see what I got. All right, 3 ways to fund it. Now in this room, there are a lot more ways than 3 to fund a deal. But for people who are just starting out, we want to keep it simple, right? 3 ways to fund the deal. Who has used cash or savings to fund a deal? That is the easiest potential way, right? Once you've got liquid assets sitting in the account that I got to get that deal right now. Boom. Easy to start, comes directly from it. All right, I'm going to go on the other side first. Who has used a self-directed IRA or a solo 401k to fund the deal? All right, very good, very good. Who has used this one in the middle, a HELOC, to fund the deal? Fantastic, fantastic. And this is where you can borrow, if you can get in low, let's say you're getting in 4, 5, 6% on the HELOC. If you've got anything lower, I want to know who you are. But if you can get in low with that HELOC, and then you can lend out at 12%, is that good? That's good? Did you have to really do anything? No, you were just making money on the money that's sitting there, so why not? And you don't need millions. Who started in real estate with millions? No, very few start off with, you build your millions, yes. But this is why we're here, to build. You don't need millions. You just need a structured path, structured capital, something to help you go forward on it. All right, how do you get started in private lending? Well, first things first. You'll hear me say this a lot when I talk about it, is education, 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 right? Learn all the basics. That's why you're here in this room, so that you can learn from everybody else's mistakes. People ask me, well, how do you know so much? I made a bunch of mistakes. That's life. That's how I go. But understand how private lending works and the key documents that are involved. Now, vet the borrower and the property. I mentioned that earlier. I'm going to mention it again. Vet the borrower and the property. Those 2 things are together. Always check who you're lending to. Make sure you're using proper documentation. We had that blurry example up there, which the internet was giving out, of where we're using a promissory note, deed of trust, title, closing protection letter, insurance to protect your collateral in there. Make sure that's all tied in there. And do you want to be the beneficiary? Yes, on all of that. Start small and structured. You can begin with cash, right? You can have that HELOC. You can have that self-directed IRA or 401k. I love the self-directed IRA, and I just simply because it's a tax-free, tax-deferred till I'm 59 and a half, and I'm not a CPA. So all of that, I like the tax advantages of that for me personally. But stay conservative when you're starting early. You just learn the process. And of course, along the way, you're going to build trusted relationships. We talked about these relationships like the ones in this room, the ones that are circulating, conversations you're having. Build those relationships. Partner with somebody who's got some experience that has done this for, or a group of people who have got experience and who have done this before. So again, start with education, stay within your structure, and build trust. All right. How are we doing on time? We're doing great. Well, I'm good then. Key takeaways. Private lending is what? Partnership. It's not a product on a shelf. It's not a box that I check, somewhere. It's a partnership. And it's built on those trusts. Short-term lending, we said that's what? That's velocity. And we need velocity sometimes, right, to get us going. We need velocity. Long-term lending is more stability, but you choose what fits your goals. Maybe you need a mix of all that, all in together, which is good. Safety comes from structure. I'm here to tell you that hope is not a plan. Structure's a plan, right? I can. What do they say? I can hope in one hand, and you finish the sentence on that one, right? Okay, returns, we want to make sure they're predictable and secured. You control the capital. We want control of the capital. We don't want to give the market the control of the capital. I don't want the market to dictate the terms that I'm going to get paid on, right? Start small, stay protected, and grow with guidance, those people that you know. Begin with safety. So, private lending, if it's done the right way, it's going to combine three things that we all want, which is security, clarity, and consistency on everything. All right. Next steps. Well, let's talk about some next steps. You can call me. I'm happy to talk to you. We'll do a Zoom. We'll go have some coffee. Maybe we'll meet at Loveland here. And what's the date again? February 25th at 9 a.m. So maybe we can meet at Loveland or sooner. Emails and whatnot. We can review a deal together. If you want to see what a private lending deal looks like, happy to review those with you, just so we can share the documents. Schedule that private call, one-to-one. Education first. That's, again, you hear me say that, education. Relationships next, because if you have those two things together, then opportunities will pull out, right? They'll pour out into this room. But wait, there's more. I've got a little bit more to go here. So, of course, I've got something, of course, right? So, it's the Private Lenders Playbook. I just had a class that went from mid-November to mid-December. That wrapped up. So, the next one coming up is going to be February 2nd at 7 p.m. It's 4 weeks, about an hour. Depends on how many questions that you have, because, my part's usually 30 minutes, 30 minutes, but then there's questions that comes in with it. It's recorded and it's shared, so you'll get a link back from me from the Zoom session. And it's typically it'll be $99, but for the RIA members tonight, and if you're not a member, an attendee, then it's $49. On top of that, I'm not keeping any of it. I don't want any of it. It is all going to the Central South Carolina Habitat for Humanity. So we're here to build wealth. How about along the way, we help others build something that matters, right? So that's what we're doing there. Class size, I keep it small because I want to get to know who you are. Plus, if you have a room full of 20 people, questions can make it go 2 hours. We don't want to do that. What are we going to cover? Mindset, wealth flow mindset, that's the biggest part. Is this up here? Week 1, how it fits into your financial goals, understanding risk versus security, how to think like a bank, right? Not a borrower. Those are 2 different mindsets. Structuring a loan, how to write a note that's going to protect you, what to verify before funding, and setting terms to create win-wins, not win-loss. Week 3, we'll get into the protection layer, the mortgage or deed of trust, title insurance, and collateral checks, and how to secure your lien properly in any state, because you don't have to just buy in South Carolina. I buy all over the place. And paperwork walkthroughs with real examples. In week 4, we're going to wrap it all up, managing and scaling. Managing and scaling. Collecting the payments the smart way, tracking your performance, KPIs, right, that'll go along with it, and how to grow from one loan, remember we said start small, to a portfolio. Some of you already have a portfolio in here. Some of you have one loan, right? It all depends on your experience. And by the end of the course, this is what I want you to pull out. How to fund a deal safely, how to earn steady income, and sleep well. I want you to sleep well because that helps me sleep well, knowing that your investment is protected. So lend smarter, safer, and do it with a structure the way the banks do it, which is why we sign all that paperwork, right? Again, we'll start Monday at 7 p.m. on the 2nd. I have some stuff around the table, and we're going to take question and answer here. But let's connect. This QR code, if you scan this QR code or the one on the table or the sign-up sheet in the back, I'll send you a private lender's protection checklist so you can kind of check off all of those things. But that is presentation. Questions, experiences. Who has done private lending in this room?